All right, let's just jump right into it. Today we are unpacking the highly anticipated May inflation report. We're going to break down the hard numbers, the squeeze you're feeling at the supermarket, and exactly how all of this is impacting your wallet and the wider economy. This is a crucial explainer, honestly, because the landscape has shifted pretty dramatically over the past few months, and understanding this core data is absolutely key to figuring out where we're headed next.
We've got a lot of ground to cover. We'll be hitting the macro inflation picture, the energy and fuel shock, the grocery store squeeze, consumer sentiment and cutbacks, and finally, the future of interest rates.
So, Section 1, the macro inflation picture.
The big top-line number you absolutely need to know from the Labor Department is 4.2%. U.S. consumer prices rose 4.2% over the last year. And month over month, prices ticked up 0.5% from April to May. Now, this 4.2% figure is actually right in line with what forecasters were expecting, but make no mistake about it. This represents the steepest increase we've seen in 3 years. It's putting a real squeeze on American budgets.
But if we dig just a little beneath the surface, we find the U.S. core inflation rate. If you're not familiar, core CPI strips out those highly volatile food and energy costs to give us a much clearer picture of underlying economic trends. That core rate rose 2.9% over the year, including a 0.2% bump this past month. Economists watch this specific metric like a hawk because it tells us how deeply these energy and supply shocks are literally settling into the bones of the broader economy, well beyond just the gas pump.
And if we track the timeline of this surge, you can really see how inflation has steadily built up momentum month by month. Before the Iran war began, the annual U.S. inflation rate was holding perfectly steady at 2.4% in February. But then, look at the climb. We hit 3.3% in March, 3.8% in April, and now 4.2% in May. This is being directly driven by supply chain disruptions and soaring fuel prices, which basically just increase the cost of producing, well, everything else.
Just a quick factual note on where these numbers actually come from. The Bureau of Labor Statistics, the agency responsible for producing the CPI and jobs data, is in the middle of a major leadership transition right now. Following the departure of former Commissioner Erica McIntyre last August, President Trump's nominee, the economist Brett Matsumoto, is actually facing his Senate confirmation hearing today. So all eyes are really on the agency producing this critical data.
Which brings us right to Section 2, the energy and fuel shock. Are gas prices still going up? I mean, it's the huge question on everyone's mind right now, especially as we head into summer road trip season, and the data gives us a very clear, very stark answer.
Driven by those supply chain blockades in the Strait of Hormuz limiting global oil supply, regular gas is up a staggering 40.5% over the year. Think about that. That energy index alone accounted for more than 60% of the monthly inflation increase across all items. And obviously that ripples out. Airlines are passing those fuel costs directly onto consumers, pushing summer vacation airfares up 26.7%. Meanwhile, your electricity prices at home have climbed 5.9% from last year.
The real-world impact of this is incredibly severe. Mark Wolf, the executive director of the National Energy Assistance Directors Association, hit the nail on the head. He pointed out that families are getting hit from both sides. Prices are up, and hotter summers mean we have to use more electricity just to stay safe. Average residential electricity expenditures are expected to jump 10.5% this summer. In fact, summer cooling costs are projected to hit roughly $792 a month by 2026. Since 2020 alone, cooling costs have soared nearly 40%.
Let's move over to Section 3, the grocery store squeeze.
So, is food getting more expensive? Well, you already feel it at the checkout counter, right? And the report completely confirms it. Grocery bills edged slightly higher in May, with the Food at Home Index up 2.7% over the year. And if you think, okay, I'll just eat out more to escape it, think again. Dining out actually grew at an even faster pace. The Food Away from Home Index is up 3.5% over the year.
The report actually poses a pretty funny question. Is beef the new eggs? And to answer that, we just have to look at the contrast in the data. You probably remember last year, egg prices went totally crazy because of a severe bird flu outbreak. But as that outbreak faded, egg prices plummeted 35.2% over the past year. Beef, on the other hand, it hit an all-time high last July due to supply constraints and really high demand. So as you plan those summer barbecues, you might want to budget a little extra for the burgers because beef prices are up 12.1% year over year.
And hey, if you need your morning caffeine to process all these numbers, prepare to pay up for that too. Coffee prices are jumping. They're up 17.5% from a year ago. Data from the restaurant platform Toast shows steady price hikes across the board for both hot and cold brew. It's basically a perfect storm. You've got droughts and flooding in the coffee belt straining the crop yields, new tariffs on imported beans, and on top of that, elevated international shipping and labor costs. Cafes are essentially being forced to pass these costs on to us just to protect their own margins.
Okay, to be fair, it is not all going up. The White House specifically highlighted some areas of price decline in this report, pointing out that prescription drugs are actually down 2.0% and dairy products are down 1.0% over the year. Health and auto insurance also got a little cheaper, but as the BLS report shows, shoppers are definitely still feeling the pinch month over month on staples like cereals, bakery products, and non-alcoholic beverages.
Which naturally leads us to Section 4, Consumer Sentiment and Cutbacks.
A recent national Verisight poll of 3,000 U.S. adults found that a massive 80% of Americans think an annual inflation rate above 3% is simply unacceptable. Think about how high that consensus is. 62% wanted at 2% or below. The CEO of Verisight noted that people just don't feel like their wages are keeping up, and frankly, they are exhausted from trying to make their money stretch further every single month.
And all that exhaustion? It translates directly to this shocking number, 44.8. That is the absolute lowest rating for the University of Michigan's consumer sentiment metric since they began tracking Americans' feelings about the economy, which was over 7 decades ago. Sentiment dropped 10% just from April to May alone. A clear majority of those surveyed explicitly stated that high prices are just eroding their personal finances.
Primerica economist Amy Cruz Cutts makes a really crucial point about this. Consumers are trying to make cutbacks for sure, but you can only cut back so far when the things getting more expensive are absolute necessities. When food, gas, and utilities eat up more of your paycheck, middle-income families have less room to save, pay down debt, or plan for the future. Your purchasing power is really defined by whether your income growth is keeping pace with the costs you simply can't avoid.
And that brings us to our final part today. Section 5, the future of interest rates.
So, the ultimate question. Where are prices headed next? Americans now expect inflation to run at 4.8% over the next year. That is a massive jump from the 3.4% they expected back in February, right before the Iran war began. But what are the big businesses saying behind the scenes?
Well, retail giants, especially those known for attracting discount shoppers, are sounding the alarm in their first quarter earnings calls. Dollar Tree's CFO recently noted that the impact of the Middle East conflict is lasting far longer than they initially expected, forcing them to assume higher fuel prices for the rest of the year. Walmart's CFO shared that they've already absorbed $175 million in higher-than-planned fuel costs. The warning for us is crystal clear. If these elevated costs persist, you, the consumer, are going to see higher prices hit the shelves by the second half of 2026.
So how does the Federal Reserve actually react to all this? Late last year, concerns about low hiring prompted the Fed to cut rates 3 times to stimulate the economy. But look at where we are today. Step 1, they evaluate the job market. Well, it's strong, over 100,000 jobs added in each of the past 3 months. Step 2, they evaluate inflation. It's rising at 4.2%. So step 3, forecasters have totally shifted their expectations. Unless there is some sudden negative shock to employment, the Fed is going to have an incredibly hard time justifying any rate cuts right now. In fact, forecasters are even starting to price in the possibility of a rate hike.
This wasn't a terrible report, but it absolutely complicates the path forward. So I want to leave you with this thought. As new Fed Chair Kevin Warsh steps into his very first meeting next week, how exactly is he going to balance a surprisingly hot job market against a consumer base that feels completely, utterly tapped out by these unavoidable costs? It is a very delicate tightrope to walk, and we are going to be watching really closely to see his next move.